Hi everybody, thanks for joining for this conference call about international business machines and YCharts focus report on the company. My name is Eric Kobayashi Solomon. I am the Director of Research for YCharts. You can follow me at IOI_Eric. You can also follow YCharts. I try to post things about the research that I'm doing and have some pretty interesting Twitter posts if you're interested in that. Now, before we start into the presentation, I should just make this disclaimer. We are not a registered investment advisor. YCharts is not trying to sell you stocks or get you to buy or sell any security. All right, with that out of the way, let's take a look at the agenda for today. First, YCharts has kind of a distinctive way of valuing companies. I'm going to go through just a few minutes of valuation methodology, and then we'll switch to talking specifically about IBM and its valuation drivers. And at the very end, we'll take a look at valuation scenarios for IBM based on our analysis of the drivers. All right, let's move to valuation methodology. All of our single stock research is based upon the golden rule of valuation, which is that the value of a company must be related to the amount of cash that that company generates for its owners over time. So how does a company generate cash flows? Well, there's only three things that a company must do to generate cash flows. The first is to generate revenues. Second is to convert those revenues to profits, or some of them to profits. And then the last is to invest any excess profits to try to boost growth in the future. Let's take a look at these drivers one by one. First, revenues. Revenues are a product of price and volume. Either you can sell a lot of stuff, that's a lot of cars, for a little money, or you can sell stuff for a lot. That's a single car that costs a lot of money. This is the quintessential breakdown between volume and price. Revenues must be generated by demand from consumers for a product or service. Now, once you've generated revenues, you have to convert those revenues into profits. The company has to pay some costs in order to generate its revenues. Some of these costs are direct ones. These are like salaries and inventory, that's the price of inputs, taxes, interest, etc. When you deduct all of those direct costs from the revenues, you come up with the cash flow from operations. Remember that because our golden rule of valuation hinges on cash flow, that we're going to be looking a lot at kind of that statement of cash flows. So the direct costs are not the only costs that a company has to pay. It also has to pay some costs to maintain the business as a going concern. We call those maintenance capex. So we start with cash flow from operations and we deduct maintenance capex, an estimate of maintenance capex, and we come up with something that a term that we've coined ourselves, owner's cash profit. This is also abbreviated as OCP. So this OCP is just another way of measuring profit, and we think that it's a better way of measuring profit than looking at net income, which can be very volatile because of accounting issues, or EBITDA, because EBITDA overestimates the amount of income that's being generated for its shareholders because it adds back depreciation costs. We think that this owner's cash profit is a really good measure of the profitability of a firm, and encourage you to take a closer look at the methodology document for our focus reports to learn about that measure. So after generating profits for its owner, a company can do one of two things. Either it can return cash to owners, in which case the free cash flow, this is the thing that we're valuing, or we're using the free cash flow to value the firm. the free cash flow to the owners is going to be exactly the same as the profits. If a company is making $100 in OCP and they are paying out $100 worth of dividends, then you can just value the company on the basis of the dividends that they're paying out. Now, it can also invest some of the money, some of the profits. This picture is a picture of a factory, so it could invest in new equipment, let's say, or maybe it could make an acquisition of a company that has equipment or sales relationships or something that company wants. In this case, the free cash flow to owners is going to be less than the owner's cash profits, spending some of the owner's cash profits on investments. But that doesn't necessarily mean that the company will be valued less. Remember, these are investments, and so they're risky, that's true, so they might not work out. But if they are successful, then in the future, the owner's cash profits, the profits of the firm, are going to grow really quickly and maybe be greater than they would if they hadn't have invested at all. Now, these kind of investments take a couple years to assess, so usually we take a look at investment efficacy, is what we call it, in kind of a medium term, a medium time frame, time horizon. You can learn more about kind of the valuation methodology and about investment level and efficacy by reading through that methodology document that's attached to every YCharts focus report. So eventually, no matter how big of an investment a company makes, it's not going to really move the needle in terms of growth in profits. We can see this happening all the time. People call this the law of large numbers. Simply, when you're very big, it's hard to grow really fast. So now that we have an idea of these three drivers, let's take a look at what the process of analyzing drivers is. A good analysis allows for an investor to see how, let's say, revenues are changing over time, how profitability is changing over time, and then how much money is being spent on investments, and deducting that out to finding out what the free cash flow to owners over time is. What we'll do is use this historical perspective and allow that to inform our assumptions about the future. This is converting an analysis into a valuation, and this is exactly the process that we'll go through with IBM today. Without further ado, let's take a look at IBM's valuation drivers. And before we start into this, this is a very brief look. For a really full look at IBM, I'd encourage you to download the IBM Focus Report, which you can find on YCharts' site under the Resources tab. Okay, let's go through each of our valuation drivers, revenues, profits, and investment level, and look at how those drivers have been for IBM. First, let's take a look at revenue growth. This chart might be a little confusing at first. Basically, this black line is a high watermark, the highest percentage growth of revenues over a 5-year period. This orange line is a low water growth, just the opposite, the lowest percentage growth for revenues over a 5-year period. And this green line is very volatile. This is the year-over-year change in year-over-year percentage change in revenues. This blue line is actually a rolling change of revenues. Take a look at 5 years worth of aggregate revenues and then compare that to the next 5 years of aggregate revenues, or the 5 years ending in the next year, and compare that on a year-over-year basis. We think this has a lot of benefits in terms of looking at how the firm is growing over a longer time frame. Note also that we've got acquisitions down here at the bottom. We'll talk a little bit about IBM's acquisitions in a moment. The first thing that I noticed when I took a look at this IBM chart was just how zigzaggy and sawtooth these years have been, and that worried me a little bit. My picture of IBM is a very stable kind of company. The more digging that I did, however, I realized, okay, we've got the tech downturn in 2001, so we would expect some revenue decrease at that time. It turns out that this next decrease is the selling off of the PC business to Lenovo in 2005. And so it looks as though this is a big decrease right here, but in fact, it's just kind of an historical accident. After that, you can see revenues growing over the next couple of years. And then again, with the mortgage crisis, we can see revenues going down. The last couple of years of revenue declines have been related to their hardware business. This is a server business, which is in decline, and we'll talk about that in just a moment. So if somebody put a gun to my head and said, how fast is IBM going to grow over the next 5 years, I would take a look at this and say, it's not going to be 15%, and it's probably not going to be negative 10%. It's probably going to be somewhere between 0 and 5%. Just looking at the kind of businesses that IBM is involved in and the kind of customers it has, that seems like a pretty reasonable assumption to me. So let's take a look at future revenue drivers. First thing to point out, down here at the bottom right, I've got IBM revenues by business split out. Most of IBM's revenues are actually made up of services, the services business. We've got about a fifth of the revenues being generated by the hardware business, and just about a quarter of revenues being generated by software. Keep that in mind because the profit split up is a little bit different, and that should be interesting as we look at that too. So thinking about how revenues will likely change in the future, as I mentioned before, the hardware business is in decline, part of it. This is $7 billion worth of revenues related to Unix servers. We've got $3 billion worth of revenue that is being sold to Lenovo. That sale was just announced this year. So there's going to be some definite headwinds in the hardware area. Mainframes, which are their other big hardware product, are very stable. They've got like a 95% market share, so it's a pretty nice, solid niche for them. The services, they've got some headwinds in that they're kind of reorganizing and realigning their business. So it could be that they lose some customers here. They're losing part of their hardware business, so it might be harder for them to bundle hardware with services, so maybe that's going to be a little bit of a headwind. But on the other hand, they're kind of trying to beef up their cloud services business, so maybe that will kind of offset some of the declines. It's kind of difficult to know, but just considering the nature of this business, pretty stable business, business that tend to have long time frames and have a good backlog, or have pretty good visibility into what clients are renewing and so forth. We can probably expect kind of stable, slow-growing sort of revenue stream there. Now, software is one area where I think IBM really does have the ability to grow a little bit. They're finally starting to commercialize Watson, which is their artificial intelligence system, and then combine that with an acquisition that they made in 2013, SoftLayer, which deals with cloud provisioning. These two things, plus some of their what we call middleware software offerings, really may be a boost to growth and maybe offset some of the hardware weakness. By the way, I'm running through this very quickly, but you can take a much more detailed view of these revenue drivers and about IBM's competitive position by taking a look at the YCharts focus report. Here we've got recent history, kind of the best, worst, and typical revenue growth for IBM as a whole over time. All right, with revenues kind of well understood, let's take a look at the next driver, which is profitability. Now, in this chart, I've got the absolute dollar value of the profitability. This is OCP here in these blue columns, and then the OCP margin, that's owner's cash profit divided by revenues, listed by this green line and associated with this right axis. So you can see back in '92, this is when Gerstner took over the company. It had almost gone bankrupt. He realigned the company as a services business, and we can see that average margins headed up into kind of the mid-single digit area, moving more away from hardware, more towards services and software. We can see these subsequent jumps up to about the 10% level and now into the mid-teens level. So over the last 5 years, it's made about 14% OCP margins in general. This is what has happened to the company historically. Now let's use what we know about the company to look at what may happen in the future. So each segment, each of IBM's segments is going to be affected by the cloud. Before we talk about that, here is the chart for the profit share by segment. Notice that even though software is a pretty small part of revenues, it is the largest part of profits. So software is a really profitable business for IBM. This is the reason that the present CEO, Remedi, is trying to focus more attention on that business and a lot less attention from hardware, which is a fairly large part of revenues, but is much less percentage of profits. It's not as profitable of a business. So in the future, because it's selling off its least profitable line, this is the x86 line of servers, the hardware segment will stand to be more profitable, and I believe it will be. Services and software are probably going to be about the same if IBM can really leverage their software business, their artificial intelligence. It's possible that revenue growth is going to be pretty good, and so that will be a higher part of revenues, and will because it's a high margin revenues, it'll be a boost to overall profitability. In terms of recent history, just what we saw in the chart before, kind of mid-teens percentage for both best, worst, and typical in the last few years. Okay, so now let's go ahead and turn to the next driver, which is investment level. First thing that's very noticeable, first of all, let me explain. This is what we call net expansionary cash flows. These are any cash flows that are spent after spending for maintenance capital expenditures are done. Any number that is positive, see right here, this is the absolute value of those cash flows. That's where the company is spending money to try to expand their profits. These divestments, or these negative values, are divestments. This 94 divestment was Gerstner divesting some data centers, trying to right-size the IBM organization. This is actually a divestment of IBM's networking business to AT&T notice that this is right before the big crash, and in fact, IBM seems to be pretty good at selling businesses just at the point where they're still marketable. In other words, someone still wants to buy them, but they have a downward trajectory. So they sold networking to AT&T back in '99, right before the big telecom bust, and then here, right before PCs headed south, or just as they were heading south, they sold that business to Lenovo. So we can see that over the last 5 years, the levels have, the absolute amount of spending has changed a bit, but in general, it's been about 1/5 of profits. So IBM is making about 15%, 15% profit margin. It's spending about 20% of that, so about 3% on expansionary projects. That's not a lot of spending. You can see the lumpiness, so it's not consistent either. What's the story behind that? Well, the story is that IBM is a capital-light business. On the hardware side, it's selling off its fabrication facilities, also called fabs, for its chips. And rather than investing in asset-intense businesses, it's spending money on next-generation IP for the chip business. So kind of moving towards capital light, less capital expenditures. However, at the same time, it's trying to acquire businesses, and so that's where the lumpiness comes from. You can expect to see probably some more services acquisitions and some more software acquisitions in the future. In the recent history, this is kind of the best, worst, and typical over the last few years. So this is how much IBM is spending on investments. Let's see how effective those investments have been at generating growth in profits. This is what we call investment efficacy. You can read in the focus report methodology section why we measure profit growth versus US GDP. There's some good reasons for that, and we think it's a sensible approach. And generally, when you see this chart, any light column that's above this axis means that on a year-over-year basis, the firm grew its profits faster than the economy grew at large. These darker blue lines is the 5-year rolling performance. So over a 5-year period, IBM, it looks like, has outperformed the U.S. economy a lot more times than it's underperformed. And so looking at this, this is purely a subjective measure, but it looks like IBM is doing a pretty good job of generating value in the form of profit growth on behalf of its owners. So taking all of this into consideration, let's turn now to try to turn this analysis into an actual valuation using a couple different scenarios. Now you remember that I used both best, worst, and likely or typical. This is exactly what I'm going to do for the valuation. Take a look at a best case, likely case, and worst case scenario. So what you see right here, this is also in the report. These are the historical statistics for each of these revenue drivers. And these are my valuation assumptions. Now, for my valuation assumptions, I'm not trying to create or not trying to make some big leap of faith saying, they're going to come out with this great new hit product. Basically, what I'm doing is using the historical results to inform my projection of future results. I have to do this intelligently so we don't make the behavioral bias of anchoring, but in general, I think these valuation assumptions are certainly much more transparent than what you'll get anywhere else from an investment bank, and really allow you to take a look at what machinery might cause a change in value. So in the best case, hardware does okay, and software and services really take off. We see IBM in this kind of a scenario, IBM trading for about $286 a share. The likely case is a little more modest of a share appreciation, about 28% above present market prices for the company. And worst case valuation, where the hardware market continues to deteriorate, the software gains really don't come through, there's not a quick revenue boost from software, and maybe the services business kind of struggles a little bit. This is still generating a worst case valuation that is pretty close to the present market price. So what we've got, it looks like here, is kind of a truncated downside and an extended upside, which is a really nice kind of situation for an investor. Again, YCharts is not in the business of making stock recommendations. What we're trying to show is how to use YCharts data to value a stock and think about the valuation of a stock in a sensible way. You can learn more about the valuation by downloading one of the focus reports and looking through the valuation methodology section. Okay, that's what I've got for today. Thanks very much for tuning in. If you have any questions about the tools that I've used to create these reports or to analyze a stock, please take a look at this URL, info.ycharts.com, and then /get focus report tools. Or you're also welcome to just send the guys on the sales team a note and ask for a demonstration and for a free trial. The YChart system, the data is really very powerful. We're getting our data from Morningstar, which is a terrific data provider, and really allowing that data to be used in a very useful way for RIAs, for hedge fund owners, and for serious individual investors. Thanks very much for joining in for the presentation today. Please come back again and see what we've got here at YCharts.